Welcome to our Liechtenstein Financial Services podcast. In the Liechtenstein Financial Services podcast, we will primarily focus and explore the legal, regulatory and tax perspective of banks, funds, asset managers and other participants in the Liechtenstein Financial Center. And as usual, this is a production of PwC Liechtenstein. I'm Patrick Wiech, your host, 11 years of experience in auditing and consulting banks and other financial institutions. And today we are discussing IFRS 18, the new standard for presentation and disclosures in financial statements. In this episode, we dive into the new standard. The standard is a crucial development for businesses across industries, and understanding its implications is key to ensure compliance. I'm very happy that today is joining us Sebastian Gutmann, director from our IFRS Tech Office and leader of the financial instruments team at PwC Switzerland. So welcome, Sebastian.
Thank you very much, Patrick. Very happy to be here.
It's good having you here and talking about this very interesting topic. And Sebastian, as an introduction, do you mind talking a bit about yourself and your connection to Liechtenstein? I know you are very much in love with hiking, so Liechtenstein must be very close to your heart.
Well, yes, I mean, you're as always extremely well informed. Unfortunately, I have to admit that I have never had the pleasure of hiking in Liechtenstein. But I heard it's quite beautiful, so I will put that on my list for the future.
Highly recommended.
Okay. Yeah, very good. Then maybe we can connect afterwards for a couple of routes. So I'm a director in our IFRS technical office here in Zurich. I've been with the firm for more than 10 years. I've originally started out as an auditor, and then a couple of years ago I joined the IFRS technical office. I am leading the financial instruments topic team, so primarily dealing with the standard of IFRS 9, very exciting one, as you know, and IAS 32, but also some more broader topics, not only related to financial instruments and financial services entities. Connection to Liechtenstein, I mean, we are the IFRS technical office for, of course, both Switzerland and Liechtenstein, so I'm also supporting our audit teams and our clients, of course, in both of these territories.
Awesome, yeah. We also had the pleasure of working together quite some time, so it's always valuable to have your insights and inputs, and very happy that you now give our listeners also a bit of details of the new standard about IFRS 18. So, Sebastian, what does this standard specifically address?
Well, so IFRS 18 is the new standard for presentation and disclosure in financial statements. And let me maybe be quite explicit up front. So it doesn't introduce any new measurement requirements into IFRS. It is really just focusing on presentation and disclosure. And why is that? Because we already have a standard that deals with presentation, and we also have a lot of disclosure requirements in all kinds of IFRS and IES. Well, the origin, I think it's worthwhile to have a little bit of history here, is that investors were concerned and raised those concerns to the IASB that they get not sufficient transparent information about the financial performance of entities they have been analyzing, and that also the financials between entities in the same industry or across industries are not really comparable because entities have different measures of profit, or they structure the statement of profit and loss, their income statement, slightly different way, and therefore this led to reduced comparability for them. So this is basically the origin or the issue that the IASB is trying to address with this new standard of IFRS 18. If I were to maybe just give you a high-level overview of the new areas that have been introduced, or the bigger changes as compared to the original or the currently applicable IAS 1, it would be that we have now 5 categories in the income statement. So those are operating category, investing, financing, income taxes, and discontinued operations. Those 3 or 5 categories, they are segregated from each other by means of subtotals, mandatory subtotals that need to be included, and those kind of border the various categories. Then another very exciting one and quite new and I would say revolutionary almost is the introduction of management-defined performance measures. So those are non-GAAP measures that are currently out there as a subset of APMs that the standard now brings into the audited IFRS financial statements going forward. And the last one, maybe worth to explore, is that the standard setter introduced new criteria for aggregation and disaggregation. So let's say the categories, they focus more on the income statement, and the management-defined performance measures also focus more on performance, so also on more of an income statement lens. This aggregation, disaggregation is really focusing on all of the primary financial statements and the financial statements overall, so including the notes. So it provides criteria for, what needs to be aggregated, disaggregated, or should be aggregated, disaggregated, to give really a useful structured summary in the primary financials, and then also split out what are the material information that should be disclosed in the notes.
Okay, you mentioned a few interesting topics. Actually, important for me is always that it doesn't introduce new measurement requirements. Yeah, it purely focuses on presentation and disclosures. However, Sebastian, as you probably and as you also highlighted, right, this shouldn't be underestimated. Disclosure is an important topic, I believe, right? You mentioned these new categories that you referred to. Can you expand a bit on them a bit more?
Yeah, so I mentioned 5, right? But I would say there's 3 main categories. So that's operating, investing, and financing. And as I mentioned before, they're segregated by use of these mandatory subtotals. So those being operating profit, so basically everything that is above the line of operating profit will be in the operating category. Then we have profit before financing and income tax, so everything below operating profit but above operating profit before financing and income tax is an investing category. And then you have the profit before tax, which is basically then the financing category that goes until there. So diving into these categories, so operating it's not entirely defined in the standard, but it is, in my own words, I would say, the results from the main business activities and everything else. So basically, it's the residual category that doesn't fit into the investing or into the financing category. That would end up in the residual bucket, I would say. Then you have investing, and what goes in there is what investors usually want to analyze separately from the main operating activity. So those are results from assets that generate a return individually and largely independently of other resources of the entity. It's basically the results from your cash and cash equivalents, and it's the returns from investment in associated companies and joint ventures that are accounted for using the equity method. Then you have financing, and what goes in here is basically how the entity finances its operations. So all income and expenses from liabilities that involve only the raising of finance would go in here, and also interest expense and effects from changes in interest rates on other types of liabilities. So for example, think about your provisions or pension liabilities that would also end up here. So let me maybe make it clear more clear with an example. Think about a manufacturing entity. You have like your you're producing a good and selling that good, and in doing so you create sales and you have depreciation that would all end up in operating. Then you maybe have also invested a little bit in equity instruments of another entity. It's not related particularly to your manufacturing process. Those would generate returns, largely independent from other resources of the entity that would meet the definition of investing, and the results from those fair value movements would go in there. And then you have maybe a bond outstanding because you want to finance and operations. You have interest expense related to that would end up naturally in financing. So I would say this is maybe bringing it a little bit to life, what goes into the different categories. And it's now a very simple example because it's a manufacturing entity and it's primarily for which the standard has been written. But now let's maybe try to apply those same categorizations to an investment and retail bank, and you starting to get probably a little bit of sweaty hands because it doesn't quite work that well with a retail bank and investment bank. So here, luckily, right, the standard setter acknowledged that this definition might not work for all entities. So they also implemented a requirement that entities need to assess whether their main business activities include specified main business activities such as investing in assets or providing finance to customers. And if you have assessed that and you come to the conclusion, yes, I actually do have specified main business activities, you can bring income and expenses that would end up in either investing or financing then back into operating.
Okay.
Yeah. So think about again the investment retail bank. I would expect that most of the items of income and expense will actually end up then in operating, and then as a consequence we would only see a very, very small number of items not included in operating. So maybe you have some results from associates that would be investing, you have maybe some interest on lease liabilities that would go into financing, but the rest would more or less be operating. Similarly, for an insurance company, same logic applies, with the exception that maybe here you have a little bit more in financing.
Okay, interesting. So quite a bit that will be changed. So, but there are some known allocations, but some pieces and bits and pieces are challenges and updates, and then you refer to banks in particular, for which the new requirements are also applicable. And banks in Liechtenstein, and we talk about IFRS 18, so this is also applicable to Switzerland as well, right? Are often structured as group companies with branches across the globe. So what do you expect from development point of view from the standard regarding FX treatment and such derivatives?
Yeah, I mean, you mentioned two areas for which the standard actually introduced new explicit guidance, and that is not because it wants to be overly complicated. Those, if you read it, it looks very complicated, but this is to actually help prepare us to get to a consistent classification in the P&L. So that actually you achieve the objective that, FX, that gains and losses on derivatives, they are consistently classified between the entities in the same industry so that it in the end becomes comparable. That's why we have this additional guidance. And if you want me to dive in a little bit, so on the FX, here we have in the foreign currency guidance basically a principle that says that the FX follows the underlying item. So if I have an item that, say, monetary item, for a corporate, a loan in foreign currency, I have FX movement on that, it would go into financing. Why? Because the underlying item is a financing, borrowing type liability. For a bank, as stated before, most of it is anyway going to end up in operating. Therefore, it's not that big of a change. But for a corporate, it can be quite a change, because what you see currently in the practice is that most entities have actually they're putting all of their FX differences in one single line, and that's quite often it's part of the finance cost. So that is a big change, as I said, more for corporates than for banks, but still. Another thing you touch upon is derivatives. So for derivatives, I expect, most of the derivatives, they end up in, the gains and losses from derivatives end up in operating. There is, however, guidance around that gets you into a different bucket. So for example, if you have entered into a derivative for the purpose of managing identified risks, then you can get it into the same bucket as where the income and expenses from the managed risks will end up. So here, one thing that you probably think about is immediately, hedge accounting relationship. If I have designated derivative in a hedge accounting relationship, actually the movements of the derivative that follow the underlying hedged item. Okay, that's fine. And then, interestingly, the standard also introduces the concept of those derivatives that are not designated in a hedge accounting relationship, but still used to manage identified risk. So you think of your economic hedging, right? And here also the same applies like to those that you have entered into for hedge accounting or designated in a hedge accounting relationship. So here also, if you entered into for the purposes of managing those risks, you follow the underlying item, the hedged item movement, even though it's just economic hedging. So that's quite a revelation. But as said before, it's mostly for corporates, because banks, they had it in operating, and it will likely also be there then in the future for under IFRS 18.
Okay, that's good. So you typically also have your in-briefs, right? That you kind of publish occasionally about specific topics. Huh?
Oh yeah, I mean, it's very good that you remind me, because everything I say, even though it might sound like a lot, and I realize I've been talking quite a bit, but everything I mentioned is just very, very high level. So if you want to have more information on what I've just mentioned, if you want to take a little bit of a more deep dive, I would say a first good source to consult would be our in-brief. So we do have one general in-brief on IFRS 18, and we have one specific for financial institutions. And then also, I definitely would recommend consulting the standard if you feel that you want to have a little bit more of a deep dive, and if you need to implement it for sure, it won't be sufficient to just consult our in-briefs.
Yeah, and listening to the podcast, of course. Right? So that's also a good summary and source to get familiar with the topic. As you introduced the standard, Sebastian, you referred to these new categories that you already alluded on, and you also mentioned some revolutions or changes regarding management-defined performance measures, right? Can you give us a bit of detail about them?
Yes, so these management-defined performance measures, or MPMs in short, they are basically a subset of alternative performance measures. So those we've been familiar for quite a while now, right? As we needed to make additional disclosures on them, but outside of the financials. And what this does now is it brings a subset of those APMs into the financials. And what kind is maybe best elaborated in light of the definition. So an MPM is a subtotal of income and expense that is used in a public communication outside of the financial statements, and it communicates management's view of the financial performance of the entity as a whole. Also, it's not specifically required by any other IFRS, so in that case it would be excluded from the MPM guidance. So in my own words, it is a measure you communicate outside, it reflects your performance, and it's a subtotal of income and expense. And maybe to illustrate that, so think about, let's say, core net interest income. That I would consider to be an MPM. Whereas another measure we see quite frequently, the net new money, it's not a subtotal of income and expense, therefore it would fall outside of that category. It's still an APM, but it would not be considered to be an MPM. Then, we sometimes get the questions of what about ratios? So, ratios, we say, okay, it doesn't meet the definition of an MPM, but it could contain either in the numerator and in the denominator, it could contain an MPM, and therefore, if that would be the case, you would also need to present it together with the other MPMs. So it basically what the standard is trying to address is it brings all of these measures of performance into the financials. And how it's doing that is it requires preparers to present basically all of these MPMs in a single note to describe them, and then also to provide a reconciliation to the closest IFRS number that we see in the financials. So that will certainly add some transparency as to why it is an important number, and also what is deducted from the IFRS figure to get there or added. So maybe to also then make the bridge to the financial services industry, I believe that contrary to most other industries, the financial institutions can maybe often have more alternative performance measures based on balance sheet metrics or regulatory measures, and rather than say subtotals of income and expenses. And then accordingly, I also expect that many of these APMs that are currently used by financial entities will not be within the scope of these new MPM guidance, but some will for sure.
Yeah, interesting. Yeah, that's a very important topic, and a big change is ahead actually, because banks, when it comes to, for example, assets under management, right, is a popular figure that are presented separately. So this all applies to such numbers, right?
Yeah, I mean, the assets under management would then not be in MPM, but it's definitely within the realm of things you need to consider. You need to go through all of that investors. Presentations and all of your public communications to assess, okay, which would be the ones that we would need to take into the notes of the financial statements and need to be audited.
Yeah, okay. Look, lots to think about. Sebastian, you talked about changes to the presentation of the income statement, just in summary, which will be divided into a few categories. Yeah, we mentioned 5: operating, investing, financing, income taxes, and discontinued operations. And you also talked about changes to the treatment of these management-defined performance measures, MPM. Or quite a bit of changes ahead of us. So when will IFRS 18 become applicable, and who does it affect?
Yeah, so it will be applicable for annual reporting periods beginning on or after 1st of January 2027, so with earlier application being permissible, as always, essentially. But, from what I hear from the market is there's not a huge appetite for early application at the moment.
Okay, yeah. And now we are in 25, so there still seems to be a lot of time to get ready for it. Do you agree with that statement?
You would already assume that I don't, right? So, yeah, it seems far along, but keep in mind that, I didn't mention it, but the standard needs to be applied retrospectively. That means that also your comparison period needs to be presented in line with IFRS 18. And in order to get the comparative, so that means the period 2026, you need to start early, because it involves, maybe adjusting ERP systems in a way that you can map the accounts to the new structure. You might even change your chart of accounts, stuff like that. So it should be should be in good shape at the end of 2025, so you're able to collect this information for 2026. So I recommend to not wait too long. Also, you might want to talk to your investors relations people to assess what is it that we put out there in terms of APMs and which potentially meet the definition of an MPM, and establish a process to, in the future be able to detect if new measures of performance are being communicated that might need to be presented in the financials.
Yeah, and it also includes probably speaking to management, board of directors on how they want to present the income statement going forward, right? So in this whole project setup, that should start kind of soon to make sure that you have your comparables ready in 2026. So.
Agree. Yeah.
Any additional tips, Sebastian?
Well, look, I think maybe not necessarily a tip, but it is a great opportunity to clean out some stuff, right? So I call it the spring cleaning, which is I did last weekend, but maybe it's something to also think about going forward for the financials. We've all seen it in the past. You look in notes of other liabilities, and there's an other in there, and think again about that stuff, and also in terms of aggregation, disaggregation, providing useful information. So you can basically clean up a lot, also with the application of this new standard, and so it's worthwhile to have a good and thorough thought about how you want to apply this, and then, as said earlier, starting early is key. It's not yet the point to panic, but you should definitely get going. And from discussions I had with clients, they already started their assessment of impacts, and also identified needs to modify their ERP system to get it in shape to capture all of these changes. So reach out to your investors relation. Think about processes. You don't want to create a situation where at 1 week before the release of the financials, you realize, we have communicated another different measure of performance that might need the definition of an MPMs, and then we might run into problem with coping and getting that into the financials. So it also has control implications. So think really robustly about how you want to tackle that.
Yeah, perfect. We didn't talk about auditors yet, but auditors are certainly also one of the stakeholders you may want to take on your journey, right?
Yes, particularly if you believe there's any contentious issues during your assessment, it's worthwhile to discuss with them earlier rather than later. We know from experience, also from the bigger standards in the past, that early involvement is key to a smooth process, at least as smooth as it can get. Yeah.
Perfect. So, Sebastian, thank you so much for this insightful discussion on IFRS 18. As you alluded, right, companies should begin preparing for mandatory adoption by 2027, quite early. And those who start with the process early will be better positioned than in the end to adapt these changes, right? That's probably fair to say.
That's definitely fair to say, yes.
Good. And whether it's reviewing internal systems or seeking expert assistance, preparation is key. And this includes also taking on board all of you or your stakeholders internally as well as externally.
You're absolutely right.
Sebastian, that was very insightful. Thank you so much for joining us today.
It was my pleasure. Thank you for having me, Patrick.
And from this basis, we will dive into new topics such as legal, regulatory, or other topics in future episodes. So please stay tuned for our upcoming episodes. And in the meantime, contact us, contact Sebastian for a personal exchange on how Liechtenstein can fit into your agenda.